G'day legends, welcome to the weekly breakout. I'm your host, MICKVATAR, Michael's digital stunt double, here to explain what's going on in the world without sounding like a finance robot. This content is for general education only and is not financial advice. Please consult a licensed professional for personalized guidance. Today's question, and to be honest, has been hurting Australians for the last 2 years. Why does a US interest rate hike make your Aussie mortgage sting? Stick around. I promise we'll keep it light, fun, and 100% jargon-free. Let's break it out. First thing to know, the United States is the world's biggest economy, bigger than a footy player's ego after a grand final win. So when the US makes a move, whether it's on interest rates, inflation, or markets, the rest of the world reacts. That includes us here in Australia. If the US economy slows down, global investors freak out. If the US raises rates, everyone else looks around and says, should we do that too? So here's what happens when the US Federal Reserve, or the Fed, raises interest rates. Borrowing in the US becomes more expensive. Investors start chasing US dollars because the returns are higher. The US dollar gets stronger, and other currencies, like our Aussie dollar, drop. Now, why does that matter to you and me? A weaker Aussie dollar means all the stuff we import, think fuel, electronics, parts, food, gets more expensive. That drives inflation up here in Australia. And what's the RBA's job when inflation gets too spicy? You guessed it. They start looking at raising interest rates too. Let's bring it back home. You're sitting on a mortgage. The Reserve Bank of Australia sees inflation climbing, partly because of overseas pressure, and they decide to bump rates. Suddenly your repayments go up, not because of anything you did, not even because of anything that happened in Australia, but because the US made a move and the ripple reached all the way to your living room. Let's be honest, that sucks, but it's part of the global economy dance. We're all connected, and what happens over there doesn't stay over there. Let's say the Fed raises rates by 0.5% to fight inflation in the US. Investors shift billions into US bonds and savings. Aussie dollar drops, we start paying more for petrol, groceries tick up, inflation jumps. The RBA goes, right, time to act. They raise rates by 0.25% here, and suddenly your variable mortgage goes up by a few $100 a month. Now, I'm not saying you should be glued to US interest rate announcements, but keeping an eye on them, smart move. Because when the US moves, Australia often follows. Not out of habit, but out of necessity. And if you've got a mortgage or you're planning to buy a home soon, this stuff actually affects you. All right, quick recap. When US raises rates, the US dollar strengthens. When Aussie dollar drops, Aussie inflation rises, RBA reacts, and the Aussie interest rates go up, and you feel it in your mortgage repayments. Simple, not really. Understandable now? Hopefully. If this helped explain the madness, drop us a like, smash that subscribe button, and leave a comment if you've ever said, why is my loan going up when I didn't do anything? For more weekly finance insights, real talk, and the occasional banter, this is your place. Until next time, have a breakout day, and I'll see you next week. MICKVATAR out.